ठीक है, Bismillahirrahmanirrahim. Today we are going to talk about some more essential issues. Basically, you have studied monetary theory somewhere or the other, right? So, what have you been told about the process of money creation? How is money created? जी बतलाएं. How much money there is in the economy? Suppose you want to change it, what would you do? क्या? Increase the what? The production. There is something called what does the government do when it wants to increase the money supply? It prints high-powered money. Then what happens? Is there a money multiplier, a deposit multiplier? Do you know anything about this? Inflation की बात मैं नहीं कर रहा. I'm just talking about the amount of money that. You see, if you look at the State Bank reports, they report a statistic. This is M0, this is M1. So, what is M1? What is M0? You know what high-powered money is? No, that's not. It's only currency, not demand deposits. Demand deposits are not part of high-powered money. There is something which is called the monetary base, or the high-powered money, or narrow money. There are many names, and none of them are really accurate, and there are some. But anyway, there is an amount of money which is printed. You can think of it like that, although it's not really accurate. But we can't cover all the complications today. But this is important to understand. The government creates a certain amount of money. Let's say it's actually, if you look at the statistics, there are about 3 billion rupees in circulation, or 30 billion, I'm not sure. That's the amount of currency, cash notes that you and I carry in our pockets. That is M0. But the amount of money that is broad money, M2, is counted as 70 million. So where did this 40 million come from? What is this 40 million?
Credit creation.
What is credit creation and how does it happen?
All of the loans are not taken in the money form. For example, someone borrows 100 rupees, so it doesn't take all of that, all amount. So bank keeps the required reserve ratio for State Bank and advances the rest of 90 to another person. And then
Yes?
long-term deposit in the bank.
नहीं, that's not long term. Long term, short term, वो तो दूसरी चीज है. He is correct that basically to understand this system, you have to go back to the goldsmith. That is the easier place. So all the people used to store their gold with the goldsmith. The goldsmith would issue a receipt that you have 1 kilogram, you have 500 kilograms of gold. So people would have pieces of paper which say that this person can get 500 grams of gold from so and so. So now, if you go, you can go and get that gold from the bank or the goldsmith and then give it to somebody else for purchasing or for whatever. purpose. Now, instead of doing that, which involves some hazard and risk that you have to go and keep the money safe, you can just give the piece of paper to the other person. And you can sign it that instead of giving the gold to me, please give the gold to him. So this happened, and this started happening. People used to started carrying pieces of paper which would say that this person has so much gold. And this paper could be circulated so that people don't have to go and actually get the gold and do the transaction. So now when this paper started circulating, then the goldsmith noticed that this gold that we have stays with us for years. Nobody comes in. Actually, they did a calculation that every day we have some transaction. Somebody comes in, takes some gold out, somebody comes in and puts some gold back in. But about 90% of the gold remains with us throughout the year. Only about 10% of it is used in daily transactions. So that means this 90% is sitting with us, useless. So why not make use of it? So they said, okay. Somebody came to them and said, I would like to have some loan. Actually, the goldsmith didn't have any money, but he said, okay, I'll use this. Here, you can have some gold. So, and you have to bring it back to me double. So he can now make profits from nothing. I mean, he doesn't actually have anything to give, but he steals from the person who deposited, and he gives the gold as a loan to somebody, and he gets it back, and nobody will know the difference because the gold always stays with him. But from time to time, so this started to be done widely. Many people started to lend out this gold and make money from interest. Now, the problem is that this means so what actually happens is that they don't give the person gold. Here, borrow some gold. They give a person a certificate, just like the others, that this person has so much gold on deposit with us, even though there is not. So now the point is that at this point there is some fraud going on in the system, because if everybody who has the certificate comes and asks for it, there is not enough gold to match. So this is the fundamental problem. That what happened was that for the most part the system worked fine, because people would just leave their gold in. It depends on the trust. It depends on the trust. As long as people trust the bankers that they have the gold, then nobody will want it, because your certificate is as good as the gold. But if there is a panic, if people say that, no, look, this person has made loans and there is not enough money to cover, then all people will go and demand, and if all people go and demand, then there will be a crisis, because there is not enough gold to pay all the people. Now, the system is not so unstable if the people can say that, okay, hold on, I will pay you back, but just wait, I have to get back my loan, the one that I gave. So if everybody waits a little bit, problems can be resolved. So in crises, there were many things that were done to handle the crisis. If somebody would just temporarily borrow gold from other sources and pay off, and as long as the people became confident that everybody will get paid, so the crisis would be finished, and people would say, okay, as long as the gold is there, I don't care. So that was one way. And there were many other ways. But anyway, crisis did occur from time to time. So this became the basis for what the system we have today, which is called fractional reserve banking. Now, the way because of these multiple banking crises, central banks were set up. The central banks were supposed to step in when there is a crisis going on and provide the additional money that everybody wants. Now, the one thing that was realized, that the gold is not necessary, that the paper by itself circulates as long as people have confidence in it, then there needs to be nothing behind it. So, the amount of gold written on the paper may not be actually the amount of gold that the bank has. But basically, the system that came into existence, which is currently the system for money creation, goes as follows. The government doesn't actually print money. This power has been given to the central bank. The central bank or the treasury prints the money. Now, what does the government do if it wants to raise money? What it does is it can print bonds, which are called treasury bonds. And treasury bonds are that you can buy this for 100 rupees, and after 1 year I will pay you 110 rupees. This is what the bond is. So the government raises money by this two-stage artificial process, that it prints a treasury bond which puts it into debt, and it now has to raise money to pay back. So it basically sells this bond to either the private sector. Somebody from the private sector can buy the bond, and then at the end of the year, so basically when he buys the bond, he gives 100 rupees to the government, and then he will get 110 rupees at the end of the year. Or they can sell it to the central bank. The central bank is authorized to print money to buy this bond. So the central bank prints the money and gives it to the government. Now this is very strange. Very strange, because the government can, instead of going into debt to raise money, it can simply print money. But actually, the way the system works in most places is that this is not how it is done. Basically, the central bank prints the money and the government borrows it on interest from the central bank. Now, the money that is printed by the government is the analog of gold. Now, so it is multiplied, just like, you see, if we go back to the goldsmith, people have gold sitting there of about, let's say, 100 kilograms, and the banks and the goldsmith issues certificates. They can go up to 1,000 kilograms. Yani they can issue certificates of debt as long as they have 10% of the gold that is required. This will be enough for their day-to-day needs. So, if we have certificates in circulation that I have gold 10 kilograms, you have 10 kilograms, everybody has 10 kilograms, the amount of gold that we have in our certificates is 1,000 kilograms. But the banker only has 100 kilograms. But there is no danger, because as long as we keep trading certificates, we have no problem. If somebody goes and actually tries to get the certificate, then they get the gold. Then, as long as there are a few of them, there is no problem. But if a lot of people go and start asking for gold, then you have problems. And that's what creates banking crisis. So now, the situation is that in the modern system, there is no gold. But the government, the printed money, which is the high-powered money, is actually equivalent of gold. So now, let's start from the process that the government prints some treasury bills. Basically, it goes into debt. It says that, okay, I'll pay 10% interest to anyone who gives me money. And suppose that nobody buys it from the private sector. So what will happen is that the central bank will buy it. So they always have a guaranteed buyer. So they can always get the money that they want. So now the government has issued money in the amount of 100,000 rupees. And it has issued bonds in 100,000 rupees, which has been purchased by the central bank, and now the government has 100,000 rupees. Actually, what the government has is not cash. What the government gets is just an entry in the central bank account. The central bank writes in its notebook that the government has 100,000 rupees balance with us. There is nothing there, yani no notes, no cash. It's just a virtual bookkeeping entry. Now the government has this 100,000 in its account. It also has an account. And now it says, okay, I will pay the salary of so-and-so, and I will buy this good, and I will purchase this service, and I will pay him, and so on. So for each of these transactions, it writes a check on the central bank. And now this check I take for my salary and I put it in my bank, and the person who sells the government some concrete, he takes the check from the government, he puts it in his bank. So now all of this 100,000 has been spent, and the checks of the government are lying in different banks. They cannot be actually cashed directly. Now I have money in my bank, yani I have an account in my bank, and my bank has a check which says that they have money in the central bank. Those are the reserves. Now, the standard view of monetary theory, the one which is taught in nearly all undergraduate textbooks and most graduate textbooks, is that the government prints a certain amount of money, let's say 100. Then there is something which is called the deposit multiplier or the money multiplier. It depends on it's actually the reciprocal of the reserve ratio. If the reserve ratio is 10%, then the multiplier is 10, 1 over 10%. So, if the government prints 1,000 rupees and the multiplier is 10, then the amount of money which comes into circulation is 10,000 rupees. And so basically the government controls the supply of money. However much they print, the actual amount is 10 times the narrow money. And how does this work? Well, basically you can think that the banks have this real cash which is sitting in them. The government printed the cash and it gave checks, and now this cash came into the banks. And let's say that I am a bank and I have people have put their salaries in my accounts, and now I have 1,000 rupees in cash sitting. Now somebody comes and asks me for a loan of 5,000 rupees. I only have 1,000. I say, okay, no problem. You have 5,000 with me. I will write you, I will create a deposit for you. So, I give him a checkbook and I say that, okay, in your checking account, I have opened a checking account for you and I have put 10,000 rupees. Now, in fact, I have put nothing. I have just wrote down that this man has 10,000 rupees. Now, next step, this man has 10,000 rupees, so he goes and he spends it. What does he do? he writes a check to somebody else. So I have my account in HBL. I borrowed money from the bank to build my house. I borrowed 100,000 rupees from the bank, and so the bank opened an account for 100,000. There is nothing behind it; it's zero. Now I write a check to the contractor. I write a check to the concrete supplier. I write lots of checks, and I spend all this money, my money. So all of these people go and deposit their checks in their own banks. Now, those banks, then there is a agency which is called the Interbank Clearing Agency. At the end of the day, you see, just like I created 100,000, so Mizan Bank also did, and Askari Bank also did. They all created loans of various amounts, some large, some low, and then checks were written coming from Askari to HBL, from HBL to Mizan, and all sorts of direction. All of these checks come into the interbank clearance, and then we go plus minus, and until we find out what's the final balance. So much was given from HBL to Mizan, and someone came from Mizan to HBL, so final balance might be zero. All of these transactions might cancel out, but not necessarily, might not cancel out. But the thing is that the overall, as long as people are not keeping cash under their pillows, the amount of money in the system is the same. Now at the end of the day, someone might be plus, someone might be minus, but overall the system has the money. So then what happens is that there is interbank borrowing. So suppose at the end of the day, all of my money is spent and nobody gave me any money. Nobody wrote a check to HBL. All of my depositors wrote check to other banks, and the other banks did not write any checks to me. So I now have to pay 100,000 to different banks, and I have no money. So what do I do? There is something which is called interbank borrowing. There is a rate, LIBOR, the interbank borrowing rate. The interbank borrowing rate is quite low because all the banks are in on this game. Sometimes I am in need and sometimes he is in need, so it's a random process. So what I do, somebody or the other has accounting entry which is plus. So I say, okay, you have surplus, please loan it to me at 2% or 3%. Now, so I borrow it. It's just overnight borrowing, because at the end of the day you need to have your book balanced. Tomorrow things might be different. Tomorrow I might be surplus and you might be deficit. Then I will loan it to you at 3%. So these will cancel out. Now the thing is that I am borrowing from other banks at 3%, but I am lending at 10%. So I am okay even if I have nothing. This is the strange thing, the magical system, that I am lending nothing. So now, in this process, you see, basically according to the standard theory which is taught in books, if you have a 10% reserve requirement, then you can keep making loans until your total loans are 10 times the amount of money you have. Because exactly as I explained to you earlier, as long as you have 10%, your day-to-day needs will be covered. When somebody comes in and says, okay, give me the cash, you have to have some cash, you can't have zero. So if your deposits are 100,000, then rule of thumb, practical from experience, is that you need about 10,000 rupees in cash. So people will come in and somebody will take cash out and somebody will put it in. As long as you have 10,000, you won't be in trouble. But suppose you do get into trouble. This is on the average. Suppose that on one day you have only 10,000 in cash, and suppose some people come in and ask for 20,000. So what the bank does is that in some branches people have asked for less, so they say, okay, wait for a minute and I will get the money from the other bank. But even if that's not enough, If it's a huge amount that's being asked for, then they can borrow from other banks. And the lender of the last resort is the central bank. The central bank is always ready. This is the duty and the responsibility of the central bank to make sure that no bank defaults on its obligations. So no matter how much money I need, if it's an emergency, I can go to the central bank and say that, give me this much money and I will pay you back when I can. So this system works. Now, the story about money creation is that the government creates high-powered money and then it gets multiplied by the money multiplier into the wide money. So I have 3 Arabs in cash, which is printed currency. Actually, the reality is even more complicated than that, because it's not really the printed currency that's the high-powered money. It is the reserves with the central bank. The central bank prints money as needed. It doesn't actually, most of its entries are just accounting entries, electronics. It's just numbers in a book. But when so if I have a deposit in the central bank, that's good enough. But if I say, okay, I want this in cash, so the central bank will, as needed, print up the cash and send it to me. It can print up cash as much as it wants. So it doesn't actually, all of the high-powered money is not actually cash, but it's useful to think of it as cash. So we have 2 kinds of money in the system, just for simplicity to understand. One is real money and one is virtual money. The real money is the cash. You can think of it like that. And then there is virtual money, which is basically demand deposits. I have in my bank account, I have 1 lakh rupees. So this 1 lakh rupee is an idea of mine that I have in my printout statement. But is there 1 lakh rupee in the bank that is sitting behind it? No. Actually, if we take all of the demand deposits of all of the people, the bank does not have the cash to cover all of them. Just like the goldsmith does not have the gold to cover all of the checks that he has issued. So the bank, this is called the fractional reserve banking system. In the olden times, when the banks would, when the goldsmith do this was called something bad, immoral, dishonest. Nowadays, it's just routine. This is part of the system. Now, so
does the virtual money have any real effect on our economy?
Of course, virtual money is money.
But it's virtual, so it's not.
It is used, you see, the money doesn't exist, you see, but I have, let's say I have a check account which has 1 crore rupees in it, according to the bank. There is no money there, but I can write a check on it and it functions just like money. So, the fact that there is nothing there doesn't make any difference. According to the theories that we have been studying, that we were taught when we were in graduate school, we were not taught this. According to the books, the virtual money is exactly the same as real money. There is no difference. And the amount of money that you study and you put in your regression models, if you want to study what is the effect of money, it is M2. M2 is narrow money, which is real money, plus demand deposits, which is virtual money. So the amount of money that we consider as being effective, and this is actually true, I mean, in an economy, one needs to have a certain amount of money to run the economy. So what is the amount of money that is present in Pakistan? It's 7 Arab rupees. The real amount of money is 3 Arab. But the banking system records that there is 7 Arab. If all of these 7 Arab people were to go and say, give me the money, there would not be that much money in the bank. There is not that much money in all of Pakistan. There's only 3 Arab in cash. So this virtual money, but it's being used. This 7 Arab is what is currently in use. People have it and people spend it and people you do anything they want with it. So 7 Arab is the amount of money in the economy, even though 4 Arab of it is virtual and 3 Arab is real.
So after the treasury bills are bought back by the government,
Yes.
Isn't there a way to dispose of the money that was printed by the state bank to cancel the effect of supply of money on our economy?
See, when the government, when I buy treasury bill, I provide the government with money. Then at the end of the year, I say, okay, here's your treasury bill, give me the money. So now this will reduce the amount of money in the hands of the government, and the government can then issue more treasury bills to cover the previous debts, or it can do other things. I don't understand, Yani, what you are trying to say. Can you explain it?
Sir, let's suppose the government issues treasury bills, and state banks buy them from themselves. Money is provided to the government, whether it's a virtual money or cash, real cash.
Yeah.
So when this increase in money supply would have an effect on the economy in the long term and the short term, whichever effect it has. So let's suppose the government buys back those treasury bills back when it's capable of paying them back the money that is loaned from state bank.
Mm-hmm.
So in order to reduce the effect of money supply, increase money supply, so isn't there a way to dispose of the increased money supply, the money that was created? Not all of it, but a part of it, so to cancel the effect of increased money supply on our economy.
According to the standard,
Also, the money is created by the state bank comes back to the accounts of state bank. So then state bank could decompose it, dispose it.
according to the standard theory which is taught to the government, is in complete control of the money supply. It can make it high, it can make it low, it can make it dance, do whatever it wants. So, if it wants to reduce it, it can reduce it. If it wants to increase it, it can increase it. It's just a question of how much high-powered money there is. So, if it buys back the treasury bonds, then it reduces the money supply. It can do so if it wants to. So, that is the standard theory. However, basically, in Pakistan, we have only about 2/3 of the money is virtual and 1/3 is real. But this is not standard terminology. I have introduced this terminology to explain something. Otherwise, in monetary textbooks, there is no difference that the virtual and real are the same. They are just money. Just like you see, when the goldsmith, he has a certain amount, 10 kilos of gold, and he has issued 10 kilos of certificates. There are people who have. Then a new person comes in and he says, okay, here is a certificate, you also have 1 kilo. Now there are 11 kilos of certificates and 10 kilos of gold. One of these kilos is virtual, but actually all of the kilos are the same, in the sense that the certificates are all the same. They all authorize the person to get 1 kilo of gold from the goldsmith. The one who has the fraud certificate, there is no difference between the fraud and the genuine. Just like that, the demand deposits that we have on the bank, we are all equal. We all have money which is written in the bank statement and which we keep track of in our books, that I have so much money. But actually, if you go to the bank, they don't have that much money. So now, everybody agrees. In Pakistan, it's only 66%, which is extra. But in advanced economies, they are more deeply financialized. The range is more like 3% to 5%. I mean, that's the amount of real money. And 95% of the money is virtual. It is just an accounting entry. There is nothing behind it. On this, everybody is agreed. Now, there is a controversy about whether money is endogenous or exogenous. The standard theories all which you are taught say that money is exogenous. Means that the government is in control of the money creation process. When the government prints 10 rupees, 100 rupees will come. Suppose the money multiplier is 10. And the government prints 1,000 rupees, 10,000 rupees of money supply will result. Because the process of money creation is supposed to be automatic. Now, what I am going to tell you here, and what the heterodox theorists say, is that no, money creation is endogenous. It means that the government is not in control. The government can create 1,000 rupees. Now the private sector, the banks and the borrowers, can make from this 1,000, 10,000 or 100,000 or 5,000. So it is their choice. So the money multiplier is not a fixed constant. It can change substantially depending on how the banks act. So it is not so then there are many implications. The money supply is not in control of the government. The government cannot predict what the money supply will be, because the multiplier exists. I mean, the banks take some money and they produce some multiple of it. But what is that multiple? That's their choice. How much they want to loan, how much people want to borrow, what the interest rates are, everything. So, because the multiplier is not fixed, but it is actually determined by the market, so actually the banks are creating money. So, now, there is a debate and an argument. Is money exogenous or is it endogenous? So, there is a lot of evidence that the endogenous money is correct, which means that everything that you are taught in your textbooks about money creation is wrong, because the government is not in control of money supply. So, the government cannot change the money. I mean, all of Keynesian theory says that you should manage the money stock to be at the right level. If it's too much, then there will be inflation. If it's too little, then there will be unemployment. But the government doesn't control the money stock, so the government cannot actually do this thing that they are supposed to do. So, there is a lot of evidence that the theory of endogenous money is correct and exogenous money is wrong. I have quoted some papers, and also there is a book by Mian Sufi, which is the target of all these lectures, but we are not going to get to it, I think. But my summary is a start, and actually reading the book will be also useful. So, basically what they show is that in order to try to save the economy from a recession, the government printed huge amounts of money, trillions of dollars. So, the amount of money you can see, in fact I had a graph of it, they have also. The amount of money that was printed is huge, but the total money supply doesn't change. So the multiplier actually adjusts. The multiplier has become very small. It used to be large because it's the government keeps printing money, but it does not have the desired effect on it doesn't increase the money supply. So that's one argument which shows that the endogenous money theory is right. The government is not in control of money creation. Money is created by the private sector. Okay, so, excuse me?
Could have been a thought that wrong government spending could have been the cause of that.
क्या मतलब मैं नहीं समझा?
Money circulation की है कि मैं कहता हूँ कि गवर्नमेंट कंट्रोल में नहीं है, तो गवर्नमेंट की रॉन्ग स्पेंडिंग की वजह से ये इशू हो सकता है कि
क्या हुआ?
Why money is not exogenous, sir?
सर बेसिकली जो बैंक्स होते हैं, कमर्शियल बैंक, इनमें जो डिपॉजिट रेशियो होती है या लोन इशू रेशियो होती है, वो सेंट्रल बैंक फिक्स करता है, तो उसकी वजह से ये तो कंट्रोल नहीं है ना आपको.
You see, that is the thing, that the ratio does not determine, as I said, when I described to you, basically you have to think what is the process of money creation, and I explained to you that actually according to the theory, the bank is, and if the reserve ratio is 10, and if the bank has 1,000 rupees in cash, then it can make loans up to 10,000, and because it makes profit on loans, so it will make loans up to 10,000. So these are the two parts of the argument, that it will make the maximum amount of loan that it can, because that's the profit maximizing part, and so the money is exogenous. That is, when the government prints 10,000, there is 10,000 high-powered currency, automatically the total amount of money which comes into existence will be 10,000, because the banks will make the maximum amount of loans that they can, subject to this reserve requirement. But the truth is not that. Actually, the banks can make any amount of loan that they like. Suppose that I only have 1,000 rupees and somebody comes and asks me for 1 crore rupee of loan. Now, according to the theory, I cannot do that. But actually I can. What I can do is that I will create an artificial entry of 1 crore rupee for this man, and I loan him this. So now there is a balance sheet. I have assets of 1,000, which is the amount of money. You see, this man has a promise to pay me 2 crores at the end of the year, let's say, just to simplify. So this promise is my asset, and the in my bank I have a 1 crore entry, which is what I have to pay him when he. So on the whole, I am in profit. I have a surplus. Now this surplus I can deposit with the central bank. This is the strange thing, that I can say to the bank that, look, I have this promise to pay from this man, and so create an entry for me on the basis of this. And so when that happens, then the central bank, or it can, if the central bank says, okay, you have 1 crore that you have to pay, but you have only 1,000, this is not enough reserves. So what I can do is I can say, okay, it's your job to lend my reserves, so I have these assets which is 2 crores, so I have lots of money, just make me a loan of 10% of 1 crore. So the central bank will make him, if it cannot get the money on interbank borrowing also, it can borrow from the central bank, or it can get it from interbank. 10%, I borrow 10% of the 1 crore that I have loaned from any bank. Or if I can't get it from any bank, I borrow it from the central bank. So I put this amount of money, cash, in my bank, and now I have the reserve ratio. So that means that I have there is no limit to what I can loan. So, and now after I have done this, now I have fulfilled the reserve requirement. My loans outstanding, the amount of demand deposit outstanding is only 10 times my cash, because I borrowed the cash to fulfill my reserve requirement. So this way I can basically create money. And this is the main thing, that the bank can create money at will. If anybody who comes in to borrow, I can create money to lend it to them. This thing is flatly denied by textbooks. Textbooks say, no, banks do not create money. The banking system as a whole creates money. You must have read this if you have gone through a monetary course, because every monetary textbook says this. It's false. This is not true. The banks actually do create money, and actually this has been written in the article by Bank of England. They say that the money comes into existence when I write that I have given a loan of 1 crore to X. So when I do that and I create an entry, then I have in effect created 1 crore of virtual money. There is no cash behind it, it's virtual money. And about 4 Arab rupees at this point is virtual money in Pakistan, which has been created by banks at will, with no control of the government. This is the key point to know, that the banks are creating money as they wish. There is no control over this process by the government. So this is what is endogenous money. Money is created within the system, produced by the system. It's not subject to the government control, which is exogenous. Now, one very important point to note is that the creation of money is directly associated with the creation of interest-bearing debt on a one-to-one basis. When the government wants to create money, they sell treasury bills, which is an interest-bearing debt. So the government creates debt, which is the government's debt, and that is the process by which money is printed. Then the same thing happens in the banks. The banks also create money. Most of the money is created by private banks, but it is only created when somebody asks for a loan. Because the bookkeeping, when I borrow from the bank, then the bank creates the money to lend to me, and it also creates an entry which is my promise to pay, so that its books are balanced and it has actually a accounting profit, even though I haven't paid it. So everything, the money creation and debt creation are the same thing. When money is increased, then the amount of interest-bearing debt is increased. Now, the main theme of this book, House of Debt, is that this debt is a very harmful thing to the economy, and the more debt there is, the more there is problems in the economy. And so one should get rid of debt. But now the thing is that this system that we are currently working with automatically creates debt together with money. And a certain amount of money is necessary for the economy to function. So in this process, a huge amount of debt is automatically created. Now, so what we are talking about here is the Chicago Plan. Actually, this same process, the process of debt creation, led to the collapse of the American economy in 1929, which was the Great Depression. And many economists who studied this carefully came to the understanding that this is a very bad system, that it should not happen that the private sector creates money and private sector creates debt in order to make money. This power should be only in the hands of the government. So they created a plan which was that there should not be fractional reserve banking. If the bank has 100 rupees, it cannot issue 10,000 worth of loans. So they said that we should go to 100% reserve banking. If the bank has if there is account demand deposits of 100,000, the bank should have cash of 100,000 with it. That's 100% reserve. Now, this leads to a problem that if we do that, then the amount of money in the economy will shrink by 90%. And this will collapse the economy. because you need a certain amount of money to run the economy. If you say that, okay, bank, you can only lend what you have, you cannot create money to lend, then there will not be enough money to handle the needs of the economy. So the solution is the Chicago plan. 100% reserve is only one part of it. The banks cannot create money, but somebody has to create money, so the government will. So the additional 90% will be printed by the government and will be given to the banks so that they can do what they used to. This is actually, the Chicago plan is a way to transition from existing system to new system. So it takes care of the changeover process as well. It says that currently the banks have all of these deposits which they don't have any backing for. So the first step in the Chicago plan is the government prints up all the money that is missing. In Pakistan it would be 4 Arab rupees, and it puts them in the bank. Okay, it just gives them to the bank that, okay, this is the as a loan. This is the amount that you are missing. This is the amount less than 100%. You only have 30% of the amount that you are owing. So I will give you the cash. So now you are fully covered. Now the bank, instead of having outstanding debts to others, the bank has now this debt to the government. Then there are other parts of this scheme as to how the government will manage and how the change will take place. But anyway, the basic idea is that there should be 100% reserve, and with 100% reserve, the supply of money will fall, which is very harmful to the economy. So the government will print the additional money that is required, and the right to print money will only be with the government, not with the private sector. So in the present system, basically, you see, the banks, what you are told and what is widely believed is that banks are financial intermediaries. What does this mean? It means that the people who have the excess money, they put the money in the bank. The people who have less than what they need, this money is transferred. So this is exactly the myth, the falsehood, the story that is being told, which is not true. The banks do not take, when they give a loan to somebody, they don't take the money which the depositors have put in and say, okay, here's the money that I have collected from the people, and I am now going to give this to you as a loan. This is not what they do. This is what you are told that they are doing. But actually they invent new money to make loans. So they create money. They do not actually intermediate. So, because they don't intermediate, so there is a product that they are selling. What is this product? It's loans. The more people get loans, the more profits they make, because this is what they are selling. So the banks do everything they can to increase the supply of loans, the demand for loans. In the roaring 20s, basically the banks, first of all, they changed the culture in the USA. Now you are in a transitional period, this generation. So you are familiar with the old values where it is considered a very bad thing to buy something on debt. If somebody wants to buy a car, he says, okay, I want to... basically, if something is needed, then of course there is no choice, you borrow money to pay for it. But if something is a luxury, I want to buy a very expensive, fancy car, but I don't have the money, so okay, I borrow from you. Please give me 1 lakh rupees from you and 3 lakhs from you, and I go and buy a car. It would look very bad. This is not culturally acceptable. But it is done all the time in the USA, that people buy car on installments. Basically, they borrow from themselves their own future income. Actually, what happens is they borrow from the bank and they promise to pay the bank in order to. But this is also a bad thing. For superfluous, unnecessary purchases, to borrow, to pay for it, and then to pay interest, this is culturally, it's not an acceptable thing, or it didn't used to be. I think the new generation, you are being attacked and you're being told that there is fine. So, one of the Pakistanis who visited America some 10, 20 years ago, he told me, people say, I've traveled here and people are driving cars for which they have taken out loans, and they are living in houses for which they have taken loans. कर्जे के घर में रहते हैं, कर्जे की गाड़ी चलाते हैं और कहते हैं अमेरिका अमेरिका. So this is the thing, that this culture of buying on credit was introduced in the USA after 1914, when the central bank was created in the USA and the power to print money was transferred from the government to the private sector. So in 6 years they changed the culture of America, and they made it popular by advertisements, by things that you can buy things on installments. So previously people didn't buy things on it. You can buy a refrigerator, you can buy a car, you can buy sofas and furnitures, everything was available in installments. So people started buying on installments. Mortgages, you can buy houses on installments. Finally, stocks. People with the money, they created an artificial inflation in the stock prices. Then they told the people that normally ordinary people don't buy stocks, but they said, look, here you buy the stock, it doubles tomorrow, you can make so much money. So why don't you buy stocks? People said, well, I have only my income is just barely enough to cover my expenses. No problem, you can borrow money. So borrow 1,000 from the bank, your interest rate is 10%, your money will double in 1 month, and you can pay easily the 10% and also make a profit for yourself. So people started to borrow and invest in the stock market. So basically the thing is that the more borrowing there is, the more profits the banks make. So they encouraged a lot of people to borrow. So now, what is the problem with endogenous money? If the private sector is allowed to create money, there are lots of problems. One of them is injustice. Why should the bank be allowed to create money and others not? If I have a printing machine where I can print, and anybody who wants to borrow, I can say, okay, I can own the whole nation, I can buy everything. So this is very unfair, that some people should have the power and some people should not. And actually the correct thing is that only the government can have such a dangerous power, and the private sector should not. Then there is inequality. If you have if one sector of the society is authorized to print money, then they can get a huge amount of the share, and in fact that's what's been happening in the USA. There is a very nice curve. I wonder if I have it in my article, but it shows that after 1929 there was a lot of regulation of the banking sector, and so the share of the top 1% started declining. But for about 50 years it declined. It reached a bottom in around middle 1970, 75 or so. Then slowly the free market ideas started becoming more and more popular. Actually, they didn't become. There was a very clear-cut campaign to make these ideas popular. Milton Friedman was an important part of this campaign. So deregulation started, liberalization of the financial sector, getting rid of all the rules. So as a result, from the 1980s onward, the share of the top 0.1% kept increasing, and the share of the bottom 90% kept decreasing, until now, very recently, the two are equal. So the top 0.1% is about to overtake the bottom 90% in terms of the population share because of the financial deregulation. Financial deregulation gives the banks the power to do whatever they want, and since they can print money, they can buy up the whole economy, and this is what's been happening in the past 30 years. People have been using this money to buy up corporations, land, anything, countries, because they can print money. And when you can print money, you can do anything. So this leads to inequality. Some people have a lot of money and most people have nothing. And it leads to inefficiency. Basically, the money that is produced by an economy, the product, it should be invested wisely. That determines your future. If you invest in useful things, education, health, factories, industries, productive things, dams, then you can increase the productive capacity and the economy will grow. If you waste it on non-productive things like stocks, land, which doesn't have any, the value of the land goes up, but there is no return to this investment. If you invested in gambling, then there is no productive return. So now, how does this system, it takes money, what does it do with it? I mean, what is done with the money that is created by banks? If it was invested in, now basically it is invested in the most profitable investment, that is the standard individual profit maximization argument. And economic theory says that the most profitable investment is also the most valuable one. But this is false. Actually, the social returns to investment are different from the private returns. So, in some sectors, investment may not be very profitable for the individual, but it may be very profitable for the society. And in others, the investment may be very profitable for the individual, like stock market or land, but it may have no value to the society. If somebody is gambling on stocks and making a lot of money, it does not create any productive value. So the money is being invested, but in wrong direction. So there is a lot of inefficiency that is created by the private creation of money. If the government was printing money, it would have more control, it would be able to use the money for more and better purposes.
गवर्नमेंट सेंट्रल बैंक से ले सकती है तो ये बाय फिर आईएमएफ वगैरह वर्ल्ड बैंक इनसे लोन लेने की जरूरत पड़ती है.
This is a very important point which I am completely ignoring here. Basically what we have is an open economy. And in an open economy, the government needs a certain amount of currency, of domestic currency, but it also needs foreign exchange to finance imports that are needed by the economy. And to the extent that it needs the dollars, then it has to go to the IMF. It cannot raise it. It cannot print dollars. So, actually, the implication of that is that to the extent possible, we should minimize our imports. But there are some components like energy, which are hard to reduce. So there are some essential things for which we must pay in dollars, for which reason we need to go to the IMF or to raise, if we don't manage our budget properly. So now,
is it possible क्योंकि अब gold का कोई role नहीं होता economy में money printing के पीछे?
The gold is not there, but the dollars are the same as gold today.
Then sir, is it possible कि हम जो central bank से loan लेती government, उस loan से आप अपनी country में gold buy करके उसको replace कर लें dollars से?
Exactly. And if I start printing rupees to buy dollars, then what will happen is that the price of dollars will rise in terms of rupees. The rupee exchange rate will fall, And there will be more rupees you have to pay. Also, when the government does this, it will also interfere with the private sector in the sense that, suppose the government buys a huge number of dollars, so the price of dollars increase. So when the imports will become expensive for other people as well. So it will have a lot of impact on the economy. These things are done, but you have to take care of all of the implications, and they are not very good. So now I will. This is some of the theory. Now I will look at some of the historical events. Now there is this. How did this very strange system of money creation come into existence? The natural system is that the government should create money and the private sector should not, and everybody can understand this. So currently this system is not in use anywhere, which is very strange. So there is a couple of books which have been written recently, Zarlenga and Ellen Brown, both of these are in they have documented the history of how this happened, and they have also tried to make the case that this is a very bad system. The private creation of money leads to many economic problems, and it should be in the hands of the government. And it was taken out of the hands of the government by clever strategies used by small groups of people who wanted to get this power to print money for their own personal benefit. And it is still working like that. There is a very small number of people who get a huge amount of benefit from this. And with this power to create money, then they can do many things. So, John Taylor Gatto has written a book called The Underground History of American Education, in which he shows that Rockefeller and certain other rich people basically captured the agenda for education, and they made the education in the schools to be such, in the US schools to be such that it would produce factory workers and it would produce people who would be happy to work for a living. Just like your education teaches you that you are for sale to the highest bidder, that when after you get your degree, you will be an input into the production function, and people will come and say, oh, okay, put him on the block, look at his teeth, okay, 10,000 rupees for this one. So the other one will say, no, I will pay 50,000. So if somebody offers him 75,000, he'll say, okay, I'm happy, I'll do whatever you want. At 75,000. If a multinational comes in, I will get paid in dollars. I will do whatever my Akka wants. So this is the mentality for factory. It's not the education is not meant to turn you into a human being, to teach you reality, teach you about truth, teach you about what this world is about and how to live. All of these things you never discussed in any of your classes. What is a human being? What are the great human beings like? How can we be great human beings? What are bad? Did you discuss any of this in any of your classes? So you are being trained to be a factory worker. So this is the education which has been captured by the rich. They want you to work in their factories and produce. You are told that you are Y is equal to F of K L. You are the L. You are the L which will produce the wealth for the wealthy. You are just an input into their machine, into their production function. Exactly. Economists usually whine about the issue that the government is creating money, but when it comes to banks and the money that is created by the banks, we don't see any economists raising the issue, whereas bank is creating money at its own. Yes, there is a behind that. Mostly what's argued is that the top economists are usually on the payroll of the banks. That's correct. You are right. So the entire government has been captured by the rich, and there is a lot of evidence for this.
It could have been in the 100 countries like Pakistan, but when we are talking about the European countries like Germany and other countries,
Yes.
they have the same policies there.
Yes. This is the policies in USA and Germany and UK, everywhere.
Why they are not breaking any laws or something like that to get that policy?
Well, look, basically that's what I'm saying here. There is a book which is by Herman and Chomsky called Manufacturing Consent. Basically, in the democracy, you need to convince people to do things which are against their interests. And so this is how they do it. They have very excellent control of the media. The media, they has been all been purchased. This is one of the things that I mention here. That newspapers and media are, previously there used to be a lot of them. Every state would have. But now there are only about seven big media sources which control 99% of all the news in everywhere. So what you see is determined by 7 people who are firmly in control, and all of these 99% are propagating the same view. And this view is one which is in the interest of the tiny minority, 0.1%, and against the interest of the bottom 90%. So, for example, at the time of the Iraq war, the American public was persuaded that there are weapons of mass destruction in Iraq, and that Al-Qaeda is in Iraq, and that we are going to go and give them democracy and make them free and give them all the benefits of the American system. This was all of the propaganda that was sold, and people believed it. And so they allowed the government to spend trillions of dollars on this war when it was desperately needed inside America by all of there was hunger, there was homelessness, there was decaying infrastructure. We talk about, how the infrastructure in Pakistan is decaying, the dams are going bad, and the irrigation system and there's silting and there's salination. All of these problems are there. The same problems are there in the USA, and in fact, the people, there was the Katrina was a hurricane which hit, and the whole city of New Orleans drowned as a result. And people have said that basically this was not a big problem. It was there were dams there already for the flood control, but they were not repaired and maintained properly. And if they had been maintained, this would not have happened. So there was money that was needed desperately for the poor in the USA, but the poor were persuaded to act in benefit of the rich by the propaganda. Same thing happened with the Chicago plan, you see. Okay. So that the Chicago plan was made, but it was blocked by the rich because it was against their interests. So in this article I have just told about 3 events which happened because of the power of money creation that is in the hands of the wealthy. One was the Great Depression. As I said, that the banks gambled widely and they lost. That resulted in bank failure, which resulted in a very severe contraction of the money supply, and which resulted in huge millions of unemployment, millions of job losses, millions of people hungry. And so Then there is the East Asian crisis. When you see the financial deregulation in the USA and UK and Europe was taking place about the same time. So, previously in the regulated system, the banks were not so free to create money. There were lots of rules and restrictions to prevent them. But after deregulation, they could just give loans to anybody. The regulation was very poor. So there was a lot of dollars that were created, that were available for investment. But there was not much place to invest them. So the East Asia was growing very fast for 30 years. And they had closed capital markets. They did not allow foreigners to come in. So then the US Treasury and IMF and others, they ganged up on these East Asian countries and they said that, look, if you allow foreigners to come in, we will reward you, we'll give you this and that, and we will give you all sorts of concessions. And it will be great for you because the foreign direct investment is so wonderful and it will make your economy grow, and you are already growing well and you will go even faster. And if you don't allow our foreign, then we will punish you, we will cut your trade and we will put tariffs and so on. So, what could they do? And besides, they were not really very unwilling either. They also were persuaded by these false arguments that, okay, let the foreign capital in. So this excess money which was in the hands, it was used in what is a classical financial attack. All of this money was given to East Asia as a debt. People borrowed, and with this money they invested in useless things like land and stocks, and buildings were constructed where there was nobody to buy. Whole towns were constructed, and after the collapse, these were just empty towns. I mean, there were apartment buildings, nobody living in them, expensive. So basically, all of this money was given. People invested in these things, and then it was suddenly withdrawn. When this money was withdrawn, then the economy collapsed, and all of these things which were very expensive suddenly became very cheap, and the foreigners came in and bought them. So they made a lot of profits on, and they basically collapsed the economies. Now, after that, you know that the crisis is over and things are going well, but what's happened is that the returns from the economy previously were going to the people within, and now they are going to people outside. So the economy is going along as well as before, but the profits are not going to the domestic sector as much as they were before. Same kind of thing happened in the global financial crisis. In the early 80s, Reagan passed the Garn-Saint-Germain Act of 1982, which deregulated the savings and loan industry. Previously, this was a very highly regulated industry, and they could do only a very small number of very conservative transactions. But he said, no, you can do anything. Very, very rapidly, people bought the savings loan institutions, and then they used the money in it to gamble wildly. They bought stocks in Latin America, they bought Russian stocks, they bought international stocks, they bought land, and speculated. They basically in the stock market, and they lost. I mean, there was huge losses when some of the investments that looked very promising at that time collapsed. There was the Mexican crisis, in which Mexican was doing very well, and then suddenly it collapsed. So what happened was that there was huge losses all over, and basically the threat was that all of these institutions will fail. So this time, unlike the Great Depression, the government did not let the banks fail, and so it put in about $80 billion into the industry, which, according to certain calculations, is more than the profits that the whole banking system had made over the past 50 years. So this one crisis wiped out everything. But this wasn't the worst thing. I mean, as deregulation continued, the Glass-Steagall Act, very important act, was passed in 1930 or so. Basically, the Glass-Steagall Act prevented the banks from investing in stocks or in any speculative venture. So it prevented the banks from gambling. That was repealed in 1999. And then there was another act, the Commodities Futures Modernization Act, which basically prevented, there were a lot of restrictions on derivatives and other kinds of complicated stocks. These were repealed so that you can, basically derivatives are gambles on stocks. This is what derivatives are. That is, I say that this stock will double in 6 months, and here is a certificate, and if you buy it, and if it doubles, then I get paid, and if it doesn't double, then you get paid. It's a gamble between us. Terms can be different. Derivatives can be written to order. So these are used basically to insure gambles. Suppose I think that this stock is going to double. So I buy $1 million worth of this stock, and I expect that in 6 months it will be worth $2 million. And so I say, okay, so now there is a risk that suppose that it doesn't double. So I have no problem as long as it goes up. But suppose that it goes down. So I can get a derivative saying that, well, if this stock goes down, then you will pay me the difference. That however much you will cover the loss. So you don't expect it to go down. So I can buy a derivative so that I can make a gamble and I can be insured against any possible losses. So these derivatives allow you to gamble on stocks without taking risks. So these were not allowed for various reasons, but they were made allowed. So this happened in 2000. This is wrong. It's not 2007. This was 2000. In 2007, there was a huge stock market crash. Didn't take very long. Trillions of dollars were spent in bailouts. So, this is just a history of how having a lot of money and spending it in the wrong way, investing it in the wrong things, can lead to economic disasters, catastrophe. And
2007 economic crisis was also due to mostly due to the virtual money created by the banks. So does that have any effect?
Yes, that is part of the story. It's not the whole story, but yes, that is definitely.
Billions of dollars that were paid to the banks in a bailout plan.
Yeah.
That, according to the Chicago plan's idea of providing the money.
No, that has nothing to do with the Chicago plan. The banks were. What happened in the global financial crisis was that people were putting huge amounts of money into housing. And then initially, you see, the housing market was very simple market. There was a bank. It would make a loan to a person living in the neighborhood. They know the person, they know the house. They would give him, and they know that he has the income to pay. And so there was no problems in the mortgage industry for 50 years. Then suddenly somebody had the idea that, look, this mortgage is an income stream. The man has promised to pay $1,000 a month for the next 30 months. So this promise I can take and I can sell to somebody. So that was called a mortgage-backed security. Suddenly, these securities were in great demand because it was thought that these are very safe, and they were in fact very safe. The mortgage securities were very safe because most mortgages, the companies did a very good job in screening and making sure that the person can pay, and so they would give him a huge loan. You get $100,000 loan, and then you pay $1,000 every month for the next 100 months. So these were very safe loans because people took very great care to make sure that the person and the house and everything. And there's another thing about the mortgage-backed security. Suppose that for some reason the man cannot pay, then the house is there. So you can take the house, and if the worth of the house is 100,000, then if the man can't pay, you take the house, you always make a profit. So it's guaranteed, no possible loss. So people say this is a great thing. So what we will do is, we will start marketing these mortgage rates. So they created securities that, okay, here is a security. I take 100 mortgages, and I say, okay, this is a security which will pay $100,000 every month. Who wants to buy? So people wanted to buy. This is just like a bond. Now there were lots of dollars in the market, excess dollars, which had been generated by this creation of money. So these excess dollars were seeking returns. Now the returns were very low. The treasury was offering 2%. Foreign investments had become very bad, very highly risky. So these were American dollar-based securities which were paying very good returns. So people said, okay, let's buy. People started buying these. So there was a demand for mortgage-backed securities. So money started flowing in. Does somebody want to buy a mortgage? Yes, okay, I'll give you money because once you get a mortgage, I can sell it in the security. So suddenly, what happened? This process is described very clearly in the book Mia and Sufi. Suddenly, people who had nothing, they would come in and they say, "Do you want to buy a house?" All right, I'll buy a house. How much is the house? House is $100,000. Okay, I give you a loan for 100. You go buy it. What about my income? Oh, don't worry about it. So everybody could get money to buy a house. Why? Because people were buying these securities. Now everybody has money to buy a house. What will happen? Everyone wants to go buy a house. The house price will increase. The house prices started increasing. So now this became even more attractive. People said that, okay, I don't have any money today. It doesn't matter. I buy a house, it will double in 1 year, I will sell it and I can make a profit. I don't have to have any money. As long as I can make the payments for 1 year, that's fine. And making payments for 1 year wasn't too difficult. So I make a monthly payment of $1,000. I buy a house worth $100,000. I only have to have $12,000. $1,000 every month for the next year. And then after a year, the housing prices are shooting up. I will be able to sell it at double what I bought, and I will have a huge amount of money. So, with this, more and more money started flowing. It was a cyclical process, just like it's called a bubble. It feeds on itself. So the prices started increasing, more money started coming in, and more people started buying. And ultimately, what happened was that these people started to fail. I mean, the mortgages were being given to people who were not able to pay. So ultimately, slowly, some people started defaulting on these mortgages, and then more people started defaulting. When the default started, then suddenly these securities started to look risky, and then people stopped investing, and when the money stopped coming in, then the housing market collapsed. The prices of the house was 200,000. Now it is 10,000. because what happened was that there was a fire sale. I mean, now everybody is trying to sell and nobody can sell, so people can get. Actually, I met a doctor recently. He said that he was in this period and he stopped doing medical practice. He bought several houses in the neighborhood which were more than 100,000 at $5,000 each. He bought 4 houses and he put them for rent, and he is making a comfortable money. So all right, so the Chicago plan was to prevent the private creation of money, which leads to all of these problems. And there is an article by IMF authors who say about the Chicago plan that it will have many benefits.
Strong spot from the Syria.
Yes.
वैसे जनरल क्वेश्चन था कि एजीएम जो की हुई है उसके अंदर हम ऐसे बड़ी बड़ी बातें करते रहे, स्कूल ऑफ थॉट डिस्कस होते रहे, डेमोक्रेसी को हमने कहा कि डेमोक्रेसी बहुत अच्छी है, बहुत अच्छा चल रहा है, मतलब पाकिस्तान में डेमोक्रेसी अगर नहीं चल सकते डेमोक्रेसी क्यों हम शरिया के बारे में डिस्कस करते हैं ऐसे पॉइंट्स के ऊपर, क्या हमें किसी का डर किस चीज का है?
All right, that's not relevant for today's discussion. We can. Yes. ये तो अभी नहीं कह सकता. I'm planning to finish in 10 minutes. This article is entitled "An Islamic Chicago Plan." It has some discussion. इसकी अलग से इसमें एक link है जिसमें there is a discussion of the Islamic angle. मेरे review में भी Islamic angle is discussed very clearly. So currently I'm trying to explain some simple things and then more complicated things later. So basically the Chicago plan says that you should go to 100% reserve based system and only the government should create money. And this is what the Sharia also says, that the private creation of money is not permissible and only the government can create money. So one thing it will happen is that business cycles will be eliminated. Today we have everywhere there is business cycle. Sometimes the business is booming, other times it's there's large unemployment, and in fact macroeconomic theory was called business cycle theory because the whole goal was to try to smooth things out so that you would have full employment continuously rather than sometimes boom and sometimes bust, which is very harmful for the people who are facing a lot of uncertainty in their lives because of this. So basically what happens with the private creation of money is that the private sector uses a pro-cyclical money policy. Pro-cyclical means that it goes along with the cycle. When there is a boom, when there is a huge expansion, prices are rising, jobs are, then the money will be expanded because people are coming in asking for loans and the private sector is ready to supply any amount of loan that they can. So this is harmful because actually, according to Keynesian theory, in the boom time, you should reduce the money supply because there can be inflation. And the opposite, when the economy is slack, when there are few jobs, nobody is producing, and so then the number of loans will be few. People will not want to invest in such a situation. So the amount of money created will be reduced. And this is again exactly opposite of what needs to be done according to the Keynesian theory. When the economy is slack, when there are few jobs, then you should pump money into the economy. And that's what the government can do, but cannot be done by the private sector. So business cycles will be eliminated if we follow the Chicago plan. There will be no more bank runs. Bank runs are caused by people losing confidence and going, give me the money. So the bank always has 100% money, so there is no possibility of bank run. Then as we have seen that the government borrows in order to print money. So instead of borrowing, it just prints money. So it will not have to borrow. If it doesn't have to borrow, it will not have to tax to raise the money to pay the interest on the bonds that it has put out. So the taxes will be reduced and government debt will be reduced. At the same time also private debt will be reduced because the system here is such that in order to create money you have to create debt. So now if the government is printing the money and money is being printed without debt, then the private sector debt will be much reduced. They will not have to borrow all that much money, because the money creation will be independent of debt creation. And there will be increased efficiency of production, because the money will be directed towards productive investments like health, like education. These are sectors in which the private sector does not invest, because the returns are much more social. And if we provide education, you cannot really get a lot of money. Even the value to society of education is much higher than the private sector returns. So social returns are much higher than private sector returns, so the private sector doesn't invest in it as much as is needed. So if the government was investing, then it would be able to change this. Now, if the Chicago plan is all that wonderful, then why has it not been implemented? Basically, the problem is that it has been blocked by the wealthy elites. And the thing is that in 1929, the wealthy elites did block the Chicago plan. It was raised, but they were not able to block a lot of different laws for the regulation of the banking industries. One of these was the Glass-Steagall Act, which said that banks cannot speculate. It was a 30-page act which basically clearly said that there is no possibility of banks investing in stock market, in speculation. Many indirect methods could be used. Those were also ruled out, that you can't do it like this. You can't make a third-person agent and say, okay, you go and invest for me, and so on. So that was very simple and clear. Now, the thing is, what is very important is that this time, the rich people, the top 0.1%, was very much well prepared. They manufactured this crisis, because this crisis did not harm them. This is the very important thing, that it harmed 90% of the public. They were wiped out. Today in America, homelessness and hunger is at the highest levels historically since the World War II. Also, 90% of the public was very much harmed by this crisis. But the top 0.1% did not suffer. Actually, they gained from this. As I said, they bought up all these houses, 100,000 houses for $5,000 and so on. So even in the bailout, what happened was that the system is collapsing. So the government gave trillions of dollars to the banks which had caused the crisis, and nothing to the homeowners who were losing it. This is one of the main points of Mia and Sufi. Mia and Sufi show that if the government had given the money to the homeowners who were not able to pay mortgages, everything could have been saved. The banks would be saved, the homeowners would be saved, the economy would be saved. But instead, the government gave $1 trillion to those criminal banks. This is like, you see, if you have a knife and it creates a wound, then instead of putting the medicine on the wound, you put the medicine on the knife. That's what happened. So, that shows how much control they have. Now, after the 2007, people said, okay, so the problem was caused by the banks gambling, so let's stop it and let's bring back the Glass-Steagall Act. So now they did. There is something called the Dodd-Frank Act, which is supposed to be the equivalent of Glass-Steagall. But Dodd-Frank has 300 pages, not 30. And all the expert lawyers say, oh, there are so many loopholes to avoid that. Although it says the idea is that it should prevent, but there is one exception and two exceptions and three exceptions. Any clever lawyer can find 100 ways to avoid this and be legal and still gamble. So basically, the point is that the top 0.1% was prepared that there is going to be this reaction and we are going to control it, and they did. So there were a huge amount of discussion about something called macroprudential regulation. How can we prevent this from happening? But zero action. Today, the system is exactly the same as it was before the crisis, and many people have said it. So the next crisis is just a matter of time. It's not going. Nothing has been done to prevent it. So now, what are we doing? Basically, here, I am saying that battle is lost. In the USA, they have lost the battle. In Islamic countries, we still have a chance. So, we might be able to change the system if the people can wake up and understand. What I am saying is very complex. I have explained it to you because you have some background preparation in economics. This needs to be understood that the system that we are following is not a good system. First of all, it's not an Islamic system. And it needs to be changed. It has a lot of potential for harm. It has not been realized. In Pakistan, we haven't had these monetary crises that have been, because our system is we only have a small amount of financialization. Like I said, 3 Arab rupees to only 4 Arab virtual money. In most places, 95% of the money is virtual, and the private sector has a lot more power. In our countries, it's not the case, so it's possible to do some things that are not possible there. But it's not going to be easy because still the financial elites have a lot of power, and it's possible that they can prevent this change from happening. So, this we have covered a lot of issues that arise